Cisco booked $9.3 billion in AI orders, and the stock fell anyway, while the company's renting compute got repriced higher the same night. 4 more stories moving the tape. Let's get into it. Cisco sold the picks and shovels of the AI buildout better than anyone last quarter, and the market paid the compute landlords instead. Cisco closed fiscal 2026 with a record $17.3 billion quarter, up 18%, and guided fiscal 2027 revenue up 15% to $72.8 billion. Hyperscaler AI infrastructure orders hit $4 billion in the quarter and $9.3 billion for the year, roughly 4.5 times the prior year. The stock fell 4.6%. Management called it a networking supercycle, then said gross margin compresses on a heavier hardware mix, and that is all the tape heard. This is the cleanest evidence yet that AI CapEx has moved past accelerators into switching and optics, and the clearest warning that the layer carries worse economics. The bear case, orders are not revenue, and a mix shift into low-margin hardware lets Cisco grow the top line for years while margins grind lower. Watch the gross margin guide on the next call. Above 67%, the supercycle holds. Below 60%, Cisco is a box vendor, not an AI winner. The same night Cisco's hardware mix got punished, the companies renting out compute were repriced upward. Nebius jumped 34%, CoreWeave 19%, Supermicro 19%, dragging the S&P 500 to a record 7,748.50, and the Nasdaq to 26,588.49. Nebius was the standout. Revenue up 454% year over year to $582.3 million. Adjusted EBITDA of positive $236.2 million against a $21 million loss a year ago. And contracted year-end power raised from 4 gigawatts to 5. CoreWeave more than doubled revenue and guided the third quarter to $3.45 to $3.6 billion. The signal is that the NeoCloud model has crossed from a CapEx story into demonstrated operating leverage. Nebius flipped EBITDA positive while still spending heavily. The bear case. These are contracted revenue businesses funding multi-year power and chip commitments with debt, and one large counterparty renegotiating changes the entire math. If NVIDIA's August 26th call shows data center revenue tracking those commitments, the landlord trade extends. Any hint of a digestion phase and the leverage cuts the other way. Cerebras proved the same split inside a single income statement. Its cloud business won, its own hardware lost. Core revenue came in at $290.9 million, up 103%, and above its own guide. And full-year guidance was raised to $82 million. Cloud and services hit a record $1 million, up 200%, but hardware revenue fell 10% to $54 million, and the stock dropped as much as 10% after hours and 19% in pre-market. Read next to Nebius and CoreWeave, that is the night's verdict. Investors will pay a premium for recurring inference capacity and will not pay for one-time system sales, even from the company that invented the wafer-scale processor. The bear case. Growth. This steep means Cerebras deploys its own systems into a lower-margin rental business instead of selling them outright, which consumes cash. Watch the customer concentration disclosure in the filing. If that cloud line still rests on a handful of contracts, 281% is a sales cycle, not a market. AI servers just passed the iPhone at Foxconn for the first time in company history. 51% of revenue against 29%. Han Hai posted record second quarter net profit of $59.97 billion, roughly $1.86 billion, up 35%, and above consensus, with operating profit up 68%. The cloud and networking division climbed from 48% of revenue in the first quarter to 50%. The world's largest contract manufacturer is now primarily an AI hardware company, and Apple is the smaller half of it. Foxconn is preparing to build NVIDIA's Vera Rubin servers and guides multiple-fold AI rack growth this year. The bear case. Management named CoWoS advanced packaging as the binding constraint on 2027 output, a ceiling that sits at TSMC, not at Foxconn. And assembly margins stay thin, whichever box fills the rack, the same problem that just cost Cisco 4.6%. The next read is Applied Materials after today's close, guided to about 50% growth in advanced packaging spend. Confirmation there means the CoWoS ceiling lifts. Lovable closed a $400 million Series C at a $13.3 billion post-money valuation, double its $6.6 billion mark from December, led by Menlo Ventures and the EU-backed Scale Up Europe Fund, with Tencent participating. Annual recurring revenue has nearly tripled from $200 million, and the Stockholm company says it is tracking toward a $600 million run rate by the end of this month. Since launching in November, users have created more than 60 million projects, and apps built on Lovable draw over 9 million monthly visits. This is the application layer finally producing a European asset at frontier lab multiples, and a direct read on how fast software development is migrating to natural language. The bear case, $13.3 billion on a $600 million run rate, is a 22 times forward revenue multiple with no moat at the model layer. Lovable rents its intelligence from the same labs its competitors do. Watch net revenue retention at the next round. Above 120%, this is a durable platform. Near 100, the tripling was a land grab. One tape, two verdicts. The market is paying for compute that recurs and discounting compute that ships in a box. Cisco, Cerebras, and Foxconn sell the hardware. Nebius, CoreWeave, and Lovable rent the output. Watch which side Applied Materials lands on tonight. This has been the Daily Alpha. Subscribe for tomorrow's briefing.